The greatest investors understand this and use downturns to their advantage. Instead of selling, they buy more when prices are low, knowing that panic-driven selling creates bargain opportunities. The power of patience is best illustrated through the concept of compounding. Compounding is the process of reinvesting earnings to generate additional earnings over time. It works best when left undisturbed for long periods, yet most investors sabotage themselves by constantly tinkering with their portfolios, trying to time the market or jumping from one stock to another. Every time they sell, they interrupt the compounding process, reducing their potential gains. Those who are patient allow their investments to grow exponentially, reaping the full benefits of time in the market rather than trying to outsmart it. One of the biggest misconceptions about investing is that success requires constant action. In reality, the opposite is true. The less frequently an investor buys and sells, the better their long-term results tend to be. This is because every transaction comes with costs, both in the form of fees and taxes, but also in the risk of making a poor decision driven by short-term emotions. The best investors do not chase the next hot stock or react impulsively to news events. Instead, they choose high-quality investments and hold them for years, allowing their value to compound over time. Patience also requires resisting the urge to compare oneself to others. In investing, as in life, there will always be someone who appears to be making money faster. The rise of social media and online trading platforms has made it even easier for investors to see others boasting about their short-term gains. This creates a false sense of urgency, leading many to abandon their long-term strategy in pursuit of quick profits. However, those who understand the true power of patience know that real wealth is not built overnight. It is the result of years of disciplined investing, ignoring short-term noise, and allowing time to do the heavy lifting. In the world of investing, the majority follows the crowd. They buy when others are buying, convinced that rising prices mean endless gains, and they sell when fear takes over, running for safety when markets decline. This herd mentality is deeply rooted in human psychology. We seek comfort in numbers, believing that if everyone else is doing something, it must be the right decision. But history has proven that the greatest opportunities arise when you do the opposite. Contrarian thinking, the ability to go against the crowd at critical moments, is one of the most powerful strategies for building wealth. The market is driven by emotions, and when the majority of investors act on emotion rather than logic, prices become distorted. When optimism is at its peak, stocks become overvalued. When fear dominates, prices fall far below their true worth. Contrarian investors recognize these emotional extremes and capitalize on them. Instead of buying at the top when everyone is euphoric, they remain cautious. Instead of selling in panic when fear grips the market, they see an opportunity. This mindset requires incredible discipline because going against the majority often feels uncomfortable. One of the most famous examples of contrarian investing happened during the 2008 financial crisis. As markets collapsed and fear spread, most investors fled, desperate to protect their remaining wealth. Stocks of even the strongest companies were being sold at ridiculously low prices, simply because the market was in panic mode. Those who followed the crowd locked in their losses, selling their investments at rock bottom prices. But the few who stayed rational, recognizing that fear had created historic buying opportunities, made life-changing fortunes in the years that followed. They bought when no one else had the courage to, and when the recovery came, their patience paid off. Contrarian investing is not about blindly opposing the crowd at all times. It is about recognizing when sentiment has gone too far in one direction and positioning yourself accordingly. This means having the discipline to sit on the sidelines when markets are overhyped and having the courage to buy when fear creates bargain opportunities. It means ignoring the noise of financial media, which often amplifies market extremes, and instead focusing on fundamental value. The best investors understand that short-term trends are driven by emotion, but long-term success is built on logic and patience. However, being a contrarian is not easy. It requires the ability to withstand pressure, both external and internal. When you go against the crowd, people will question your decisions. You will feel doubt creeping in as prices continue to rise after you refuse to chase them, or as markets keep falling after you have started buying. But the key to being a successful contrarian investor is trusting the underlying principles rather than reacting to short-term fluctuations. History has shown that markets always revert to their true value over time, and those who can separate themselves from the emotional cycle of the majority stand to gain the most. At its core, contrarian investing is about seeing what others fail to see. It is about recognizing that human psychology creates cycles of euphoria and panic, and positioning yourself accordingly. The greatest opportunities in investing do not come when everything looks safe and easy. They come when fear is at its highest and confidence is at its lowest. Those who can master the art of going against the crowd are the ones who reap the greatest rewards. In investing, flashy moves and high-risk bets often grab headlines, but the real secret to long-term wealth isn't found in sudden windfalls, it's found in consistency. The investors who build fortunes don't do so by chasing trends or timing the market perfectly. They do it by following a disciplined strategy, making rational decisions, and staying committed to a long-term approach. Consistency is what separates those who achieve lasting financial success from those who fall victim to the market's unpredictable swings. One of the biggest mistakes investors make is believing they need to constantly adjust their strategy to stay ahead. The truth is, frequent buying and selling often leads to poor decisions driven by emotion. Every time an investor reacts impulsively to market noise, they increase the likelihood of making a costly mistake. Studies have repeatedly shown that the more often people trade, the worse their results tend to be. Why? Because they let short-term events influence their long-term plans. Instead of sticking to a proven strategy, they chase gains, sell out of fear, and ultimately lose sight of the bigger picture. The market is unpredictable in the short term. Prices fluctuate daily, sometimes for no logical reason. A stock that is up one day might be down the next, and economic news can send investors into a frenzy of buying or selling. But over the long run, the market follows a clear upward trend. Those who have the patience to stay invested and the discipline to ignore short-term volatility are the ones who benefit the most. The longer an investor stays in the market, the greater the power of compounding works in their favor. Consistency in investing means resisting the urge to constantly seek the next big thing. Many investors get caught up in hype, whether it's a new technology, a trendy sector, or a company everyone is talking about. They jump from one investment to another, hoping to strike gold, but the most successful investors don't fall into this trap. Instead, they choose solid, well-established companies with strong fundamentals and hold on to them for years. They don't panic during downturns, and they don't rush to sell when prices surge. They understand that the key to wealth isn't found in chasing short-term gains, but in allowing their investments to grow steadily over time. This disciplined approach also applies to saving and reinvesting. Consistent investors don't just put money in the market once and hope for the best. They invest regularly, whether the market is up or down. This strategy, known as dollar cost averaging, ensures that they buy more shares when prices are low and fewer shares when prices are high. It removes the guesswork from investing and eliminates the temptation to try timing the market. Over time, this steady approach leads to significant wealth accumulation as small, regular investments compound into substantial returns. Perhaps the greatest challenge of consistency is maintaining discipline when the market experiences extreme highs or lows. During bull markets, it's tempting to become overconfident and take excessive risks. During downturns, it's easy to panic and abandon a long-term strategy. But the best investors remain steady through it all. They don't let excitement or fear dictate their decisions. They understand that investing isn't about reacting to every movement in the market. It's about staying the course, following a well-thought-out plan, and allowing time to do the heavy lifting. Success in investing doesn't come from making one brilliant decision. It comes from making a series of good decisions consistently over many years. It's not about predicting the future, chasing trends, or reacting to short-term movements. It's about staying disciplined, focused, and patient. Those who commit to a steady, rational approach, regardless of market conditions, ultimately build the greatest wealth. Understanding human psychology is the most underrated skill in investing. While financial knowledge, market analysis, and economic trends play a role in building wealth, the greatest investors succeed not because they can predict the future, but because they understand how emotions influence decision-making. Fear, greed, overconfidence, impatience, These psychological forces drive market movements far more than logic or numbers ever could. Those who master the ability to recognize and control these emotions position themselves for long-term success, while those who fall victim to them are doomed to repeat costly mistakes. At the heart of investing psychology is the battle between fear and greed. Greed takes over when the market is booming. Investors see others making money, and the fear of missing out, FOMO, pushes them to buy at any price, believing that stocks will only go higher. This creates bubbles, situations where asset prices rise far beyond their intrinsic value. Investors become irrationally optimistic, ignoring warning signs and convincing themselves that this time is different. But history has shown that every bubble eventually bursts, leaving those who chase the hype with significant losses. On the other hand, fear dominates when the market crashes. When stock prices plunge, people panic. The same investors who once couldn't buy fast enough now rush to sell, desperate to escape further losses. They let emotions override logic, failing to recognize that markets are cyclical and that downturns often present the best buying opportunities. This cycle of emotional investing, buying high in greed and selling low in fear, is one of the biggest reasons why so many investors fail to build wealth. Another psychological trap is overconfidence. Many investors believe they can outsmart the market, time their trades perfectly, or pick the next big winner. This illusion of control leads them to take excessive risks, often without realizing how much luck plays a role in short-term success. They may experience a few wins and convince themselves they have special insight, only to suffer devastating losses when the market turns against them. The best investors understand that humility is just as important as confidence. They don't assume they can predict the future. They focus on discipline, risk management, and long-term thinking. Impatience is another destructive force in investing. In a world that rewards instant gratification, many investors struggle with the idea of waiting years or even decades for significant returns. They expect immediate results, and when they don't see them, they abandon their strategy in search of something that promises faster gains. This constant shifting from one investment to another disrupts the power of compounding, which requires time to work its magic. Those who can resist the urge for quick profits and stay patient through market cycles ultimately reap the greatest rewards. The most successful investors don't just understand market trends, they understand people. They recognize that the market is not a perfectly rational machine. It's a reflection of human behavior, emotions, and biases. They study history to learn from past mistakes, and they develop the emotional discipline to make rational decisions, even when others are acting irrationally. They know that mastering investing isn't about having the best stock picking skills. It's about mastering themselves. At its core, investing is a psychological game. The ability to remain calm when others panic, to resist the temptation of chasing trends, and to stay patient in the face of uncertainty is what separates those who build lasting wealth from those who struggle. Understanding human behavior is the ultimate edge in investing, and those who embrace this truth set themselves up for long-term success. Imagine a world where fortunes are built not on genius, not on speed, not even on sheer luck, but on something far more powerful: human nature itself. Every day, people make decisions driven by fear, greed, impatience, and overconfidence. They chase the highs, panic at the lows, and let emotions dictate their financial fate. But what if someone saw this chaos not as a risk, but as an opportunity? What if, instead of running with the crowd, they stood still, calm, calculating, and ready? This is the story of how irrational behavior, the very thing that ruins many, became the key to unimaginable wealth. It's a story of patience when others were restless, courage when fear took over, and wisdom in the face of market madness. It's proof that in a world of financial frenzy, those who master emotions don't just survive, they thrive. Welcome to the untold truth behind how human folly paved the way to greatness. The stock market is often seen as a numbers game, but at its core, it is driven by human emotions. Fear and greed, the two most powerful emotions in investing, shape market movements in ways that logic alone cannot explain. These emotions cause people to make impulsive decisions, react irrationally, and create opportunities for those who can remain calm and rational. Understanding this cycle of emotion and its impact on financial markets is one of the most valuable lessons an investor can learn. Greed is one of the most dominant forces in investing. When the market is rising, People become euphoric, convinced that the good times will never end. They buy aggressively, often at inflated prices, believing they are missing out on easy wealth. This euphoria drives asset prices beyond their intrinsic value, forming bubbles that are bound to burst. The dot-com boom of the late 1990s is a classic example. Investors, driven by the fear of missing out, poured money into technology stocks, pushing prices to unsustainable levels. Companies with no profits or even viable business models saw their valuations skyrocket simply because others were buying. This herd mentality, fueled by greed, created one of the biggest market bubbles in history. But greed is only one side of the equation. Fear is just as powerful and often more destructive. When markets decline, panic sets in. Investors, seeing their portfolios shrink, rush to sell, desperate to cut losses before things get worse. This panic selling drives prices down even further, often well below a company's actual worth. The financial crisis of 2008 is a perfect example. As the housing market collapsed and financial institutions crumbled, investors fled the stock market in terror. Many sold their holdings at rock-bottom prices, locking in massive losses. Yet those who remained calm and recognized the irrational fear around them saw an opportunity. Some of the greatest fortunes in history have been made by those who bought when others were too scared to act. The key to success in investing is not predicting market movements, but understanding the emotions that drive them. The cycle of fear and greed repeats itself over and over again. The key is to recognize these emotions in others without falling victim to them yourself. When others are greedy, prices are often too high, making it a dangerous time to buy. When others are fearful, stocks are likely undervalued, creating an opportunity for those willing to take a contrarian stance. This principle is simple in theory, but incredibly difficult in practice. It requires patience, discipline, and the ability to separate emotions from decision-making. Most investors fail because they let emotions dictate their actions. They buy high when optimism is at its peak and sell low when fear takes over. This cycle of emotional investing is why so many people struggle to build long-term wealth. The greatest investors understand it. The market is not just a reflection of economic fundamentals, but of human psychology. By staying rational when others are emotional, they can take advantage of mispriced assets and grow their wealth over time. Understanding how emotions drive markets is not just about making better investment decisions. It's about seeing opportunities where others see disaster. Fear and greed will always exist, and markets will always be unpredictable in the short term. But those who recognize these emotional patterns and remain calm in the face of chaos position themselves for long-term success. Patience is one of the rarest and most valuable traits in investing. In a world where people crave instant results, the ability to wait while others panic is what separates those who build lasting wealth from those who lose it all. The stock market rewards those who understand that real gains are made over years and decades, not days and weeks. But most investors struggle with this simple truth because they are constantly bombarded with noise, market fluctuations, news headlines, and the opinions of so-called experts urging them to act immediately. When stock prices surge, the temptation to jump in and ride the wave is overwhelming. Investors see others making quick profits and feel as though they are being left behind. This fear of missing out, FOMO, leads them to buy at inflated prices, often just before a market correction. Then when the inevitable downturn comes, they experience regret and fear, causing them to sell at a loss. This cycle of impatience is one of the biggest reasons why so many investors fail. They chase short-term gains without realizing that true wealth comes from holding on to great investments through both good times and bad. Market downturns test an investor's patience more than anything else. When stock prices fall sharply, fear takes over. News outlets amplify the panic, warning of financial doom. Many investors, unable to tolerate the sight of their portfolios declining, make emotional decisions and sell at the worst possible moment. This impatience locks in losses that could have been avoided if they had simply held on. History has shown time and time again that markets recover